Since companies learned how to operate with less revenue, their expenses are lower. When their revenues go back up, that's a real boon for something called operating leverage. So operating leverage is just a massive force on earnings that could drive companies' profits for a long time. Now, the fly in the ointment is that if the economy is doing so well in the second half of 2021 and 2022, I expect, the street expects inflation to pick up. Now, the Federal Reserve, who has the charge of short-term interest rates, has said that they don't plan on raising rates probably through 2023, maybe even later. They also said they won't just look at a few months of 2% plus inflation. That's kind of their bogey. The Fed wants to see 2% plus inflation. But they said if inflation goes above 2%, they're going to look at a long-term average, not just 1 quarter's worth of figures. We don't really know what too high of an inflation rate means yet. But at what point does the Federal Reserve say inflation is too high and this is becoming a sustainable level of inflation? And then what the Fed would do is the first step they would take is they would taper their $120 billion of bond purchases every month. And then after that, they would start to raise rates. Now, when they start to do that, will the economy have enough steam, enough velocity to outrun a pullback in help from the Federal Reserve? That's the $64 trillion question. That's the question that everybody needs to know. So that's the number one thing, the number one danger to the stock market. The next thing that could maybe hurt stocks is if stock prices have gotten way too ahead of corporate earnings. Sometimes companies can report, for example, 100% growth rate in earnings, and it's still not good enough because now the stock is priced for 200 or 300% growth rate in earnings. So at one point, the price of a stock could get ahead of its earnings growth. So that's another thing that we have to watch out for